Welcome back to CrowdWise Academy. This is Brian, and today we're kicking off Level 1 Module 2 with a very important concept, and that is human behavior and investor psychology. Let's get into it. As a reminder, here at CrowdWise Academy, you're part of the Level 1 Novice courses right now, and we're in Module 2, Investing Fundamentals. Next up, Level 2 Intermediate courses get much more into the details of early stage investing, while Level 3 Advanced courses get into actually screening and selecting your first investments and then making your first regulation crowdfunding investment. Today, what we're going to talk about is first introduce something called the hierarchy of investor needs. We're going to give an introduction to investor behavior. We'll discuss 4 psychology lessons from expert investors, such as Warren Buffett, the CEO of Berkshire Hathaway and legendary investor, Ray Dalio, who's the founder of Bridgewater Associates and author of recent book Principles, Howard Marks, co-founder at Oak Tree Capital Management, and Jason Calacanis, famed angel investor in Uber, Thumbtack, and many other companies. Lastly, we'll close out today's lesson with investor biases and then the secret weapon to help you master your own behavior. So the hierarchy of investor needs is shown by this diagram at the source below from the Motley Fool. Basically, it says that you need to start on the foundational level and work your way up the pyramid. You should not be focusing on higher levels of the pyramid before the lower levels have been mastered. Here, we can see that investor behavior is the base and asset allocation is the next level up. Those are the concepts we'll be covering in Module 2. A common investor problem is trying to solve a higher level on the investor pyramid before a more fundamental level has been mastered. A good example of this is starting on the investor behavior level. You have your 2 conflicting selves, the emotional self on one hand and the logical, rational self on the other hand. In his book Switch, Dan Heath describes these two and gives an analogy that it's similar to a rider and an elephant. On the top, the rider, is the logical you. Perhaps you have great asset allocation plans and investment strategies, but then, of course, there's the emotional you, and that's the elephant. When the 2 systems come in conflict, which one do you think is going to determine where you go? That's the power of emotions, and we'll be talking about today are ways to be able to combat those inherent biases and emotions that will often lead investors to make bad decisions. So back to the hierarchy of the investor needs, we'll be focusing on investor behavior today. So, how important is investor behavior? Don't take it from us. Let's hear from some of history's best and most famed investors. First, Warren Buffett. He said, "We don't have to be smarter than the rest. We have to be more disciplined than the rest." This goes to show that out of Warren's long and very distinguished investing career, he thinks that discipline is more important than raw intelligence and knowledge. This goes to show why mastering investor behavior is important. Next, Ray Dalio from Bridgewater Associates. He says, "Convert your principles into algorithms and have the computer make decisions alongside you." Now, this doesn't mean putting it all completely into the control of the computers, as your models and your algorithms will need to be updated over time. But what he does mean is that by having these algorithms make decisions alongside you, you can check the quality of your decisions by running them through these algorithms and then see whether they are being driven by emotions or if it's a good decision. So from these first 2 investors, let's talk about a tool that we can use in our investments. One investor tool we can use is called a Ulysses contract. This is from Homer's Odyssey, where the hero Ulysses was sailing by an island that was full of sirens, who were beautiful women whose voices would be so tempting that they would lure sailors into the rocks and they would capsize their ships completely out of their control. Ulysses longed to hear the voices and songs of the sirens, but didn't want to put him or his crew at risk. Thus, what he did is before getting to the island, had his crew tie him up to the mast and then stuff wax in their own ears. This prevented them from hearing the song and allowed him to hear the songs but wouldn't be able to take any action. Essentially, what he's doing is making a decision in his present controlled emotional self to prevent his future self from being overridden with emotional decisions. The advice from both Warren Buffett and Ray can be summed up as this: to systematize, and that's to put the rules and systems in place prior to a decision to prevent yourself from being sabotaged by emotions later. Let's continue on and look at two more investors and some advice. First, Howard Marks. He says, it's not what you buy that determines your results, it's what you pay for it. And what you pay, the security's price and its relationship to the intrinsic value, is determined by investor psychology and the resulting behavior. This is a crucial point to think about, especially when looking at startups. Valuation is often very speculative, and it's easy to get caught up in the emotions of the crowd when there's a hot deal, so to speak. Thus, as Howard reminds us, there's always a price that's too high to pay, and so you need to make sure that the price and the valuation are in line with the value of what you're buying. Next, Jason Calacanis and Yoda. Now, a quote from Jason's book Angel says, "Remember, we have more blind spots than we do clear vision, so you must unlearn what you have learned to be successful as an angel." If you actually go to Star Wars, The Empire Strikes Back, "You must unlearn what you have learned" is a quote directly from Yoda. Basically what he's saying is that it may be counterintuitive to make the right decisions when investing in startups. Often, we have to question our really deep-held assumptions and values and ask if they're going to be applicable and helpful investing in startups. So, from these two next investors, another tool we can take away is the use of an investment decision log, or writing deal memos. Basically, it says that prior to making any investment, you should write down your rationale for investing, any risks, and any other relevant information, i.e., a deal memo. Deal memos are very popular in the venture capital industry, but even individual angels and investors like you and I should be using these because it allows us to be able to look back on our decisions later in an unbiased way and also to improve our decision-making process as we go along. Now, some other investor biases to watch out for and potential traps include social proof. That's where we may look to others for advice to see what they are doing to determine whether our own actions make good sense. It's important not to rely on social proof too much, especially in a field, investing, that requires correct contrarian thinking to be successful. Think about it. If everybody knew that Uber or Facebook was going to be successful in the future, the valuation probably would have been driven up so high that it wasn't worth it and wasn't a good investment. Next, loss aversion. Loss aversion states that human decisions are unconsciously weighted more to avoid pain rather than gain pleasure. This is because we weight losses more heavily than gains. For example, losing $100 feels worse than gaining $100 feels good. Confirmation bias. When you're doing your due diligence and screening in startups, you need to be looking at all the evidence and making sure that you're not only looking for evidence that's confirming your view while ignoring anything that contradicts it. This is a subconscious human behavior, and so there's no way to completely remove it, but being aware of it can help you to do better in your screening. Next, negativity bias. Negative experiences often stick with us much more than positive ones do. Let's use an example back from the 2008 global financial crisis. Obviously, the huge drop in stocks and real estate in 2008 to 2009 was very painful for investors. But for those investors who avoided the stock market after that, because of those recent experiences of pain, they missed out on some of the best gains over the next decade. Thus, always be thinking in terms of negativity bias. If you've had any experiences, whether it's in a startup, in a business, or perhaps a particular industry, that's influencing your decision in ways that it probably shouldn't be. And the opposite of negativity bias, optimism bias. Optimism bias is a cognitive bias where you basically think that negative events are less likely to happen to you. Also, a variation of this called Russian roulette syndrome is basically where something statistically may make sense, but the potential downside is so catastrophic that you shouldn't be partaking. Think of Russian roulette, how maybe just 1 in 6 of the chambers has a bullet, but the potential outcome of that one bullet is catastrophic. We need to make sure we're avoiding these types of investments where the downside would completely wipe us out. So your assignment for today is to start your investment decision log. We've given you a template at the link below and also in the course description text. Go and download it now. Take a look and modify it to suit your own preferences. and then start tracking and taking notes on every investment decision you make. Now, the level of your notes is going to be dependent on your style and preferences. However, what's important is that you're crystallizing some of your thoughts and putting them down on paper, and then giving your future self something that you can go back to and look at in a more unbiased perspective. Make sure you download this before you start the next lesson, as there's some other useful sheets that we'll be discussing. And as always, send us feedback. Post comments with questions, and for technical or other feedback, send me an email, brian@crowdwise.org. Let's take a quick look at the investment decision log. Basically, the sheet you're going to be looking at is Sheet 3, Deal Memos. And I've put together a simple template modified from something that I use for my own personal use. So for each company, I have my investment decision, whether or not you decide to invest, the amount you decided to invest. These are just fictitious companies, of course, but this is usually the date that I invested or made my decision, the company name, the funding portal that it's raised on, WeFunder, Start Engine, Republic, etc. Describe the problem and product in one sentence is something I do just to help me be able to describe their product. Product phase, I usually just break down into something that's either a concept, MVP, minimum viable product, something that's perhaps beta tested with customers, something that's perhaps released but in pre-product market fit stages, and something that's found product market fit. This is the number of shares, if it is shares that you're purchasing, the type of offering that we'll be talking about more in Module 2, and then just some other important things. So valuation cap, deal terms, but some of the most important ones, your rationale for investing, and the biggest risks. These are some of the reasons and writings that you can go back to later on to make a decision whether and when to sell, if there is a chance to sell at an exit, or perhaps to buy more shares in a future raise. So once again, this is all just an example. Feel free to download this and modify it for your own use, but we wanted to show an example of something that you can use for starting your investment decision log. All right, once you've downloaded that and started to play around with it, feel free to come back and start the next lesson. We'll see you back at CrowdWise Academy.